Hi, I'm Stephen Dooley, Head of Market Insights here at Convera, and I'm here today to present our global FX outlook for December. Of course, the month of November was really defined by the US presidential election and the impact of Donald Trump's trade policies across financial markets. And that's really been the defining theme in November and as we move into December. And it's probably no surprise that it's had a big impact on some of our forecasts. And we'll go over that later in this presentation, but perhaps the currencies that have been affected might not have been those currencies that you might have initially guessed. But as I said, November was all about the Trump trade and the US dollar moving to a 2-year high. Financial markets essentially have already entered the Trump 2.0 era, with the biggest FX markets really driven post the US election, with the US dollar strongly higher as markets speculated that a Trump win means that tariffs and tax cuts will result in a quicker pace of inflation in the US economy. Then later in the month, the announcement from President-elect Trump that he is considering new tariffs on Mexico, Canada, and China if they don't take action around drug and human trafficking saw another big move higher in the US dollar and a big move lower in the Canadian dollar, the Mexican peso, and the Chinese yuan. Looking forward, it's going to be how the impact of trade policy plays out. That's probably going to be most consequential as we look ahead to 2025. The other big story last month in November was about rate cuts, and we saw further policy action from the Reserve Bank of New Zealand and the Bank of Korea, Brazil, the UK, and Mexico all cutting rates last month. Clearly, central banks have seen inflation coming down and thought that they now have the ability to cut rates further. But as we note in a little bit, we've started to see a rebound in inflation. And in addition to some of those policies from Donald Trump, perhaps the risk as we go into 2025 is that we see a resurgence in inflation. Looking at the big moves over the last month, as we already mentioned, the US dollar dominated up at 2-year highs, and it was particularly a strong couple of months with the overall quarterly gain at the end of November, up around about 7.5%, in line with the best quarterly result for the US since 2015. So if the US dollar can hold these gains, it'll be a very strong quarter for the US dollar indeed. On the other hand, the euro really underperformed, one of the hardest hit currencies. And I'll explain why in a moment. But worries about trade, which impact China and do impact the Eurozone, were essentially magnified by the concern that any slowdown in European manufacturing might mean the European Central Bank needs to cut rates quicker than previously anticipated. That sent the euro down to 2-year lows versus the US dollar. The British pound was lower for most of the month of November as well, initially lower after the Bank of England cut rates on the 7th of November, but did recover later in the month. And in Australia, the Aussie dollar was also weaker, but perhaps didn't fall as much as might have been expected. And that's because the Reserve Bank of Australia continues to hold out and refuses to think about cutting interest rates, even as most other developed central banks cut interest rates. The higher Australian inflation rate is the reason for the RBA currently unwilling to cut interest rates. So let's have a look at some of the major economic events and how they're likely to play out as we go into December. Well, probably one of the first events is that inflation, as I mentioned earlier, has really started to come back. And it's interesting, it really appears that inflation has come back from around about September. So, in this environment where there is the potential for a recovery in inflation, some of Donald Trump's policies, as we mentioned earlier, tariffs, which are inflationary, tax cuts, which produce more spending and therefore also inflationary, could cause the Federal Reserve to cut rates at a slower pace than previously expected. And that's why the US dollar has pushed higher over November, partly because of Trump's win, partly because of strong data, but also partly because the Federal Reserve is now expected to cut rates at a slower pace than previously expected. You can see that here on this next chart, and this is the forecast from markets about where the Fed funds rate will be in 24 months. And you can see that over the course of 2024, it really has waxed and waned. Initially, there was concerns around the middle of the year that inflation would be more persistent. That kept the Fed funds rate expectation up around 420. As inflation came off and as hopes that Kamala Harris would win the US presidential election, that caused inflationary expectations to fall, and that expected end rate for the Fed funds rate fell all the way to 2.8%. Again, we saw a big turn in October as those expectations for a Trump win increased and the expectations for the Fed funds rate quickly rose higher as well. Now, they remain at a high as we go into December. That's helped the US dollar to push up to a 2-year high. But if this chart shows us anything, it shows us that Fed funds expectations can turn very quickly. And if the US dollar does come off those highs, it'll likely be driven by a pullback in those Fed expectations. Finally, going into December, of course, the talk turns to Christmas and the so-called Santa Claus rally, which historically has seen equity markets push higher towards the end of December and the first few days of January. What's interesting is that historically, key FX markets tend to be tied to equity markets performance. Currencies like the euro, like the Australian dollar, but they've become less tied to US equity performance over the course of this year. That's probably gone some part due to the impact of worries around trade. And we've seen that in November as equity markets have pushed higher despite trade worries. Currency like the Aussie dollar and the euro have weakened, causing that correlation between those high beta FX markets and the US equity market to break down. And you can see over the course of this year, the correlation between those key currencies and US equity markets have broken down. Of course, as we already mentioned, part of the reason why is because of those tariff threats from Donald Trump. And this is a measure here of policy uncertainty. And of course, except for that COVID period, over the last 10 years, you can see that policy uncertainty spiked with Trump's win at the end of 2016. And then again, as the US-China trade war really hotted up in 2018 and 2019. So certainly suggests that we might be able to see a further pickup in policy uncertainty. And what that means for FX markets is that we can continue to see some of the wild swings that we saw in November. And it's just really a reminder of how much volatility Trump's commentary can cause and how far it can spread. Like we mentioned in the introduction, it's not all about Donald Trump's US election win. FX markets are also being driven by these rate cuts that we've seen around the world. Now, up until now, the rate cuts we've seen have been fairly coordinated. They've all moved fairly much in line as major central banks cut interest rates. But as we go into the new year, the risk for FX market volatility is that some central banks continue to cut, and we've seen big moves lower from the Canadian Central Bank and from the New Zealand Central Bank. We expect more big cuts from the European Central Bank. Some central banks might be more cautious, the UK, but especially the Federal Reserve, with inflation potentially stickier in the UK and in the US. And of course, some central banks, like the Reserve Bank of Australia, unlikely to cut rates in the near term because inflation remains persistent. And then, of course, on the other side of the ledger completely, we have the Bank of Japan potentially hiking rates as soon as December. What this means is that if central banks start moving at different paces in different directions, then the very low levels of FX market volatility we've seen all year, partly driven by the fact that most central banks were moving at around about the same pace and in the same direction. But if we start to see central banks moving at different paces and even at different directions, then that's when we can see a big return in volatility in FX markets in 2025, to say nothing about the impact of these trade concerns as well. So as we look ahead to what the big calendar events are in December, again, we already mentioned that central banks are absolutely critical and probably the most important rate decision from the US Federal Reserve on the 18th of September. But the next day, we have rate decisions from the Bank of Japan, from the UK, and from the Swiss National Bank as well. So you can really see that third week of December lining up to be one of the more volatile weeks of the year. Apart from that, we also have rate decisions from Australia on the 10th of December. No change expected there. And from the Canadian Central Bank on the 11th, currently looking likely to cut rates from the Bank of Canada, which has already cut rates 125 basis points so far this year. Okay, we'll move now on to the currency forecast. And like we said, the impact of the US election win has had an impact on some of our currency forecasts. Let's start off with the UK here, and you can see those forecasts as we look into 2025 have been lowered from around about 130 to 132 down to around 126. So a drop of a little under 5%. And again, that's taken into account that the US Federal Reserve seems less likely to cut rates now. We've seen that in the market pricing, and that means the US dollar might be able to press further higher. So the range that we had previously of around about 126 to 132 on the British pound US dollar, now dropping from around about 124 to 128 for most of the first half of 2025. And the core baseline rate there, you can see around 126. So US dollar buyers might be looking to lower their expectations. And we've already seen some of the market pricing flow in to that view with that strength in the US dollar. Again, of course, that baseline view can be impacted by a shift in global economic performance. And if we see a pickup in the global economy, if we see President-elect Donald Trump perhaps being more cautious, taking some time to implement some of these trade policies, that can help the British pound move up towards that 135 to 133 level. To the downside, a real concern around tariffs, and if the Bank of England starts cutting rates at a quicker pace, that can see us down to around 124 or lower. As I mentioned, one of the currencies that was hit the hardest after the win for Donald Trump, and one of the currencies that's seen their forecast drop, has been the euro, with a forecast for around 110 now lowered down to 105. That's again being driven by the stronger US dollar, but it's also been driven by the fact that we've seen the expectations for European Central Bank to cut rates further. And that particularly came after a sequence of really poor economic data from those manufacturing and services PMI numbers towards the end of November, really suggesting that particularly the German manufacturing sector really remains under a lot of pressure, and the European Central Bank might need to cut rates further. You can see on a real pickup in the trade tensions that potentially the euro can move below parity. That's now a possibility in this updated environment to the top side, really looking to around 110, 112 as the cap in the medium term on the euro US dollar. Of course, the Canadian dollar has also been hit hard, but not quite as much of a downgrade on the CAD versus the US dollar as perhaps we've seen from those European currencies. The forecast for the end of the year raised from around 137 to around 140, and 140 seen as the target as we go into the first quarter of 2025. The range overall, as you can see, from around 138 to 141 for the first part of 2025. Again, a move above 142 is a possibility on an extension of those trade worries. On the other hand, if we do see a slowdown in the US labor market and the Fed forced to cut rates a little more quickly than the market currently expects, that can see the dollar CAD move below that core view around down to a sort of a 137 to 134 level. But for the moment, around 140 looks to be around the new base for the dollar CAD. I mentioned that some currencies had a bigger downgrade than expected, and some currencies held on a little bit better. And the Aussie dollar is clearly one of the currencies that has been able to hold on a little better with these updated forecasts. The Aussie dollar downgraded from around about 68, 69 to around about 67 now. So only a 1 or 2 cent drop in the Aussie dollar. And we already mentioned the reason earlier, because the Reserve Bank of Australia seems unlikely to cut interest rates in the near term. According to market pricing, the market doesn't see a rate cut priced in until May of 2025. So that's providing some support for the Aussie dollar. And while we've seen some currencies like the dollar CAD and the euro dollar break out of long established trading ranges over the last month, the Aussie dollars hold on to that trading range between 64 and 69, and that seems likely to hold unless we see a substantial shift in sentiment. So for now, you can see in terms of the range around 66 to 69 at the moment. Our core view in the short term, again, a relaxation of those trade tensions can see the Aussie dollar into the low 70s. On the other hand, if we do see further stress between, or further tensions, I should say, between the US and China, that can weigh on the Aussie. Also, the Aussie dollar, which is historically very closely tied to risk sentiment, can be pressured if we see a broader sell-off in equity markets. Finally, let's have a look at the dollar CNY, and again, another market that looks like the dollar can trade higher as a result of the impact of Donald Trump's trade policies. Of course, China did see a substantial stimulus program introduced at the end of September. That has seen a bit of a pickup in Chinese economic growth, but there are still questions around China's stability as we go into 2025. That's weighing on the Chinese yuan. Also weighing on the Chinese yuan, these trade tensions. So we've seen a upgrade in the dollar CNY from around 6.95 to around 7.24. and that 724 to 730 looks to be the core expectation going into 2025. The million-dollar question going into 2025 will be whether the People's Bank of China allows a depreciation of the Chinese yuan, and whether that sees it break above that key resistance level around 730 to 735. So that's what can drive the dollar CNH higher to the downside if we do see a pickup, further stimulus from the People's Bank of China. If we do see an pickup in growth, that can certainly cause the Chinese yuan to strengthen and dollar CNY to move back lower. So certainly a really interesting update from the latest forecast in that global FX outlook. Remember, you can download the full report. We've got forecasts, high-level forecasts in more than 10 currency pairs, a whole range of shorter forecasts on another 15 or more. And if you need more information, you can certainly reach out and speak to us in the Market Insights team. But I'd like to thank you for watching the update. We hope you have a very happy holiday period. We'll be back next year and look forward to speaking to you all again. If you've got any questions, reach out to your account representative, or you can contact our website at convera.com or contact us on LinkedIn. Thanks for watching. Bye-bye.